Global market volatility has surged sharply higher since July 28th. Iran and their proxies picked a bigger fight, unexpectedly firing at the major U.S. Middle Eastern staging base in Jordan and at an LNG export terminal in the Mediterranean Sea just off the Egyptian coast, signaling a further escalation of the Iranian conflict. The U.S. responded in kind, which created turmoil in the oil and financial markets. Meanwhile, the Fed held the Fed fund rate steady at their just concluded July meeting, but U.S. equity markets, the Treasury markets, and the currency markets were anything but steady. What remained steady through all this turmoil? Gold, which probed higher. In this gold market commentary, recorded on Sunday, August 2nd, I'll explain how markets around the globe are becoming increasingly sensitive and potentially more fragile to adverse events going on in the now expanding war against Iran and the restricted flow of oil out of the Persian Gulf. I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. Let's get on with our update. This is a map of the Persian Gulf region that shows all of the major attacks from the US and Iran since July 7th. And you can see that's been quite active. But what is new is what's been happening down in Yemen, around the Bab al-Mandeb Strait, and especially in that little red circle up to the upper left in the Mediterranean Sea. That's the LNG export terminal that Iranian proxies in northern Iraq took shots at on last Tuesday, which sent the gold price up $100 and put the oil price up and put equities markets into a bit of a tailspin. So this is a sign that the conflict is expanding. Saudi Arabia now wants to put a coalition together to fight against the Houthis in Yemen. What many of you may not remember is last April and May in 2025, the U.S. had about a 45-day air campaign against the Houthis in Yemen for the very same reason. They were raising trouble in the Red Sea at that point in time, and we helped Saudi Arabia out then, and now they're back at it. So Iran is using their proxies in Yemen and in northern Iraq to expand this conflict, picking a bigger fight, and now we're taking the fight back at them. Saudi Arabia wants to put a coalition together to protect the Red Sea shipping, which means this conflict is spreading to other nations in the region who've tried to remain as neutral as possible throughout the conflict. It's getting bigger, wider. This is not a good sign. And what's happening? Well, the oil price is responding. This is a chart of Brent crude going back to January 1st. You can see the major volatility that we've seen in the oil price for Brent crude and WTIC out of the US. We peaked at $100.69 per barrel after the U.S. completed their 13-day bombing campaign, and we paused, and now we're punching back up again a bit from about $84 a barrel to a little over $90 a barrel with the renewed fighting that's occurred over this past 3 or 4 days. Now, I've watched and listened as President Trump has repeatedly come out to talk about how we're entering into negotiations, or a truce is at hand, or we're working on the memorandum of understanding, jawboning the markets lower for oil in particular. But I heard an interview with Jim Bianco this past week, who's a brilliant analyst, who said quite succinctly, every time oil goes over $100 a barrel, President Trump does something to bring it back down. He tries to talk it down, or negotiations start, whatever. So I said, well, let's put this to the test and see. So this is the same chart with all of the military activity labeled. Everything in red is aggression, and everything in green is a lack of aggression or a cease of aggression. And you can see Jim's right. It's like President Trump has a trigger at $100 per barrel. And this is a very disturbing sign. You cannot prosecute a war properly to its final conclusion that you desire if you're beholden to financial or commodity markets, which is what President Trump has been trying to do. Talk the market back down when the market went adversely against him or against us. And as I said in our last video, this is the point in the phase with restricted oil out of the Persian Gulf where a lack of continued supplies could really start to affect the available supplies sharply. This is where all the analysts said the point in time is in August, where we'll start to hit the bottom of the storage tanks that we do have available after we've used up the available shock absorber that was available in the marketplace. And we're seeing that in the spreads between the price of oil and the refined products, diesel, jet fuel, and gasoline. In January, the spread between the price of a barrel of oil at about $60 and diesel, jet fuel, and gasoline was about $30 per barrel at $90 per barrel for all three of those, give or take a couple bucks. Now the spreads are sharply higher. The spread between the price of oil and gasoline is about $50 per barrel. And for diesel and jet fuel, it's $80 a barrel, or almost double. And this goes back to July 17th when the oil price was still coming down. I don't have the latest figures for the last week or two here. And this doesn't really take into consideration what's happened in Russia fully yet, with Ukraine hitting Russian oil refineries. Russia has been an exporter of refined products, diesel, jet fuel, gasoline. Now they may become an importer, which could further strain the situation. And what's also happened throughout this entire crisis is China has been reducing their oil imports sharply to help ease the strain in the markets. But now they may be re-importing oil again. And as I said a month or two ago, when China makes that turn, it could really put some more upward pressure on the price of oil. So let's see how this all translates. But this is where the rubber meets the road. And this is not a good sign right now. It could get worse, and potentially a lot worse. We're also seeing turmoil in the financial markets, the equities markets. The Kospi, the semiconductor index in South Korea, literally puked this week, dropping from about 67.55 on Tuesday all the way to 52.90 on Thursday, about a 23% drop. Now, this has been a market that's been doing nothing but going hockey stick higher with leveraged retail buying. And a lot of people got stopped out this past week, including Leopold Aschenbrenner, whose hedge fund was heavily invested, leveraged again 4-1 in a couple of high-tech Korean stocks, got stopped out and sold to Ken Griffey's Citadel at a discount price this week. Young investor leveraging up, looking like boy genius, got a real big market lesson this week. But we also saw the Dow take a big hit, especially following the Fed's announcement that they were holding rates steady when Treasury yields spiked. We'll get to that in a minute. Now, both of these markets have recovered somewhat, but volatility is increasing. And I don't think it's any coincidence that this volatility is increasing as we're seeing an expansion of the conflict in the Middle East. More and more of these are becoming more intertwined. And here's a chart of Treasury yields going back since the conflict, before the conflict started, February 2nd. And as you can see off to the right, the Fed held interest rates steady at about 4.62% at that point in time on the 10-year Treasury yield, but it spiked up 13 basis points to 4.75% in the last three trading sessions. Fed Chairman Warsh said, we're going to let the market do our work for us. And that's what the market is doing. It's expecting higher inflation, which has remained sticky, and yields are rising further, making the cost of interest for all of us increase. So we're all going to be paying higher interest rates on new loans. And the 30-year Treasury has hit another all-time high yield going back to 2008 now, I believe, which is what most mortgages are based against. So the cost of financing is increasing, and the markets did not like that. They responded by selling off, and we're seeing Treasury values tumble. And the last time we went through an episode like this, when the Fed funds rate went from 2 to 4%, well, what happened? Silicon Valley Bank failed because their collateral, their U.S. Treasury value fell. And this is a similar type of situation. It could create further strains in the financial sector as collateral against loans in banks and pension funds diminishes against those loans. Time will tell how this plays out. But right now, the Fed is letting the market do its work for it, and the market is responding in kind. And what else has happened? Well, the Japanese yen started to tumble, and buying the yen with about $53 billion of funds, probably mostly US dollars. And we had a coordinated response from the US Treasury, which I'm told sold euros to buy yen. Scott Bessent said the yen is very undervalued and excess volatility isn't healthy. And that's what we're seeing. So here's another sign that the unintended consequences of the war against Iran are starting to ripple through into the currency markets. And what happened overnight, Saturday night, last night, President Trump said yet again on Truth Social, as he called off major infrastructure strikes which had been planned against Iran, he says we've got a potential deal. Yet this morning, Sunday morning, August 2nd, off to the right, the Times of Israel is reporting that Iran denies it asked Trump not to strike or agree to a deal to split control of Hormuz. Well, we've seen this one before. The point is, President Trump may no longer be able to jawbone the price of oil lower as we really hit lower tank bottoms and real supply shortages start to emerge. When molecules are actually missing, no amount of jawboning can affect that price. And that may be the point that we're at now. Time will tell. And here's a chart of the yen versus the dollar. Now, we had a similar intervention in April where over 6 days, the Japanese invested about 63 billion in propping the yen up, and that didn't hold. The yen eroded further, now to its lowest point in a couple of years. And we had a $53 billion intervention last Thursday and Friday, which propped the yen back up over trend line. Now, most interventions ultimately fail in the longer term. We'll see how this works out in the coming trading sessions. But this has been a big step to prop the yen up by both the US and the Japanese government. And here's a chart of the dollar index going back 16 months. The dollar has been in a tentative breakout over 101.50 on the US dollar index chart where that red line is. I labeled that breakout or fake out. And right now with this intervention, it looks like a fake out. But this is a market intervention, not true market forces at work. So we could see a bit of a rebound here. We'll see. But right now, the dollar is breaking down pretty sharply. And when you look at a daily candlestick chart, you can see how much the dollar came down due to this intervention in just the last 3 trading sessions. Down sharply and still below the peak that it hit when it first broke out at 101.80. But what I've seen recently is the most direct inverse correlation between gold and the dollar that we've seen since the war broke out. Previously, the transmission mechanism has been higher oil, higher inflation expectations, higher yields, lower gold. But gold has been resisting those higher yields, which is a really good sign. But right now, gold is also resisting a higher dollar. So what I've got is the dollar index on the left inverted, and on the right is the gold chart, both going back to May in candlestick form. And you can see how directly correlated gold has been to the dollar inversely. It's easier to see when the dollar's inverted, but this puff up in the dollar has not helped to buoy gold yet because it's been an intervention and not a true market force. But what has gold shown? Real steady behavior. In fact, it's moving a little bit higher tentatively. It punched up to 4,100 this past week, and it closed out the trading week at 40.45. So gold is holding the line at 39.50 right now pretty well. Let's take a bigger picture look. Here's the 1-year gold chart. And We're starting to see a bit of a rounding in the bottom, as I showed you in the last update that we did. So far, that is holding. That's a good sign. And the fact that gold is holding in the fact of higher treasury yields is an even better sign. The fact that the dollar has tumbled could lead gold to go higher still. We'll see. But of course, there's a lot of variables at work, and who knows how this conflict will continue to play out. But I do think the fact that Iran has picked a bigger fight could lead to a longer, more prolonged conflict, which is what I do think Iran wants. And I'll talk about that more in the future. But right now, gold is looking pretty good. I like the bottoming formation that we're seeing in gold. And we're seeing a similar formation starting to happen in silver, although it's a bit more tentative. Silver traded primarily between $56 and $58 this past week, although it did punch up to just under 60 at one point in time, but it's moving sideways and it's holding support at 55.50 so far, which is encouraging. So silver's looking pretty good. It's getting closer to moving back over that downward sloping trend line. We're still not quite out of the woods yet, but it's a bit more encouraging that it's holding for longer right now. So I'm liking the way the metals are reacting with stability and steadiness in the current market in the face of all this volatility. Platinum is moving sideways as well, holding a pretty tight range between 1565 and 1665. I didn't say silver closed out the market at 5770 yesterday on Friday. Platinum's closing out the market at about 1650 right now, to the higher end of the trading range, which is good. And palladium remains in a modest uptrend between about 1250 and 1310 right now, closing out the week at 1285. So metals are looking very steady in the face of a lot of volatility around the world in oil, equities, currencies, and especially military action in the Middle East. Whether we get a truce or not, or a real opening of the Strait of Hormuz, is anyone's guess going forward. So if you're interested in physical precious metals, we have a getting started guide you can access through the QR code. It features the most widely traded, competitively priced, and for you, easily sellable products when you choose to liquidate. We offer those same products online on our website that are priced in online, transparent, and very competitive pricing, I might add. Here are our social media handles if you'd like to follow us on social media. If you like these updates, please subscribe to our YouTube channel. And here is our contact information. So that is my updates. Thank you so much for your time today. Thank you for the loyalty and trust that you've placed in us for the last 28 years. To our regular clients, without you, we wouldn't have a business, and we're grateful to you each and every day. So let's see how this all translates. That's my update for now. Precious metals are holding very steady in the face of a lot of market volatility around the world that I think is only going to increase as time passes, as long as this conflict continues. We'll see. So thanks again, and have a great week.